The field of corporate finance does not exist in a vacuum, but is instead deeply embedded within the broader context of a nation's economic system. To understand corporate finance in different economic systems, we must first define what an economic system represents. It is the organized way in which a society provides for the needs and wants of its people, encompassing the laws, institutions, and cultural norms that dictate how resources are allocated and how wealth is distributed. Because the primary function of corporate finance is the efficient allocation of capital within a firm, the rules of the surrounding economic system act as the invisible hand that shapes every financial decision a manager makes. The scope of this topic is vast, as it requires an examination of how various frameworks, from pure market economies to centrally planned systems, and from mixed models to emerging markets, alter the fundamental principles of investment, financing, and risk management. This exploration is of critical importance because, in our interconnected global economy, financial managers must often navigate multiple systems simultaneously, necessitating a sophisticated understanding of how diverse environments impact the firm's ability to create and sustain value. In a market-based economic system, often referred to as capitalism, the foundational principle of corporate finance is the maximization of shareholder wealth. In this environment, resources are primarily allocated through the decentralized decisions of private individuals and firms interacting in competitive markets. The hallmark of corporate finance here is the existence of highly developed capital markets, such as stock and bond exchanges, which serve as a continuous feedback loop for management. When a firm makes a decision, the market reacts, and this reaction is reflected in the company's share price. A key idea in this system is the information efficiency of the market, where prices are assumed to incorporate all relevant available data. The financial manager in a market economy acts as an agent for the shareholders, and the primary challenge is often the agency problem, which arises when the interests of managers and shareholders diverge. For example, a manager might be tempted to pursue a prestigious but low-return project to increase their own stature, whereas the shareholders would prefer the capital be returned to them or invested in higher-yielding ventures. To align these interests, market economies use sophisticated mechanisms such as stock-based compensation and rigorous disclosure requirements. Consider a large pharmaceutical company in a market economy deciding whether to fund a risky new drug trial. The manager must calculate the net present value of this project by discounting expected future cash flows at a rate that reflects the project's specific risk. If the market perceives this as a value-adding move, the firm's stock price rises, effectively providing the company with cheaper access to capital for future endeavors. As we contrast this with a centrally planned or command economy, we see a radical shift in the underlying principles of finance. In these systems, the state owns the majority of productive assets, and central authorities determine the allocation of resources, production targets, and pricing. In such a context, the traditional objective of maximizing shareholder wealth is replaced by the objective of meeting statewide economic or social goals. The financial manager's role is transformed from a strategic architect of value into a technical executor of the state's plan. Investment decisions are not made based on market signals or internal rates of return, but are dictated by the government's industrial policy. Furthermore, the concept of a financing decision is simplified, as the state is often the sole provider of capital. This leads to the phenomenon of the soft budget constraint, where firms do not face the same threat of bankruptcy as they do in a market economy. If a state-owned enterprise fails to generate a profit, the government may simply provide more funding to keep it operational, especially if the firm provides essential services or employs a large portion of the population. For instance, a heavy machinery factory in a command economy might receive a significant capital allocation to double its production capacity, not because there is a market demand for more machinery, but because the central planners want to achieve a specific growth target for the industrial sector. In this environment, the cost of capital is often an arbitrary figure set by the state rather than a reflection of market risk, which can lead to significant inefficiencies in how resources are utilized. The most common structure in the contemporary world is the mixed economy, which blends elements of both market and command systems. In a mixed economy, private enterprise coexists with significant government intervention, regulation, and state-owned sectors. Corporate finance in this setting is characterized by a multi-stakeholder approach. While managers still focus on profitability, they must also navigate a complex web of social and environmental responsibilities. The state often acts as a regulator, a customer, and sometimes even a competitor or a shareholder. The importance of corporate finance in a mixed economy lies in the manager's ability to balance these competing interests. Financing decisions may be influenced by government incentives, such as tax credits for green energy or subsidies for research and development. Investment decisions must account for the regulatory environment, which might impose costs that do not exist in a pure market system. For example, an energy company in a mixed economy might find its decision to build a new power plant heavily influenced by carbon taxes or environmental mandates. The financial manager must integrate these external costs into their financial models, recognizing that the firm's long-term viability depends on its ability to satisfy both its private investors and the public authorities. This creates an immersive environment where the manager must be as skilled in political and regulatory analysis as they are in financial modeling. Another fascinating dimension of this topic is the influence of ethical or religious frameworks, most notably Islamic finance. Operating under Sharia law, this system introduces specific prohibitions that fundamentally alter the practice of corporate finance. The most prominent principle is the ban on Riba, or the payment and receipt of interest. In traditional market economies, debt is a primary tool for financing, but in an Islamic system, capital must be raised through risk-sharing arrangements. Instead of a fixed interest payment, the provider of capital and the firm enter into a partnership where they share in the profits and the losses of the venture. This is seen in instruments like Musharakah, a joint venture where all partners contribute capital and share in the management, or Mudarabah, where one party provides the capital and another provides the expertise. Additionally, all financial transactions must be backed by tangible assets, ensuring that finance remains tied to the real economy rather than speculative activities. A financial manager in this system would not take out a standard bank loan to buy a fleet of delivery trucks. Instead, they might use an ijara contract, which is a leasing arrangement where the bank buys the trucks and leases them to the firm. This system emphasizes ethical investment, prohibiting sectors like gambling or alcohol, and fosters a deep sense of communal responsibility. The underlying principle here is that wealth should be generated through productive, shared effort rather than through the passage of time or the exploitation of a borrower. The challenges of corporate finance are perhaps most acute in emerging and transitional economies. These are nations moving from a command model toward a market model or experiencing rapid growth without yet having fully developed financial institutions. In these systems, managers often encounter institutional voids, which are the absence of specialized intermediaries like credit rating agencies, reliable court systems for contract enforcement, or liquid stock markets. The scope of corporate finance here expands to include the management of institutional risk. Because formal capital markets may be weak or non-existent, firms often rely on internal capital markets or business groups, sometimes referred to as conglomerates. These groups move capital from one profitable subsidiary to another to fund new growth, acting as an internal bank. The importance of relationships and trust often replaces the formal transparency seen in developed market economies. For instance, a telecommunications firm in a transitional economy might secure its financing through a syndicate of local banks that have long-standing ties to the company's founders, rather than through a public bond offering. The financial manager must be adept at building these informal networks, while simultaneously working to improve the firm's corporate governance to eventually attract international investors who demand higher standards of accountability and transparency. The legal system of a country also plays a decisive role in shaping corporate finance. Academic research often divides legal systems into common law and civil law families. Common law systems, like those in the United States and the United Kingdom, tend to offer stronger protections for minority shareholders, which encourages the development of large liquid stock markets where companies can easily raise equity capital. In contrast, civil law systems, common in much of continental Europe and Latin America, often provide stronger protections for creditors, leading to a financial system that is more bank-centric. In a bank-centric system, firms develop close, long-term relationships with their lenders, and banks often have a say in the firm's management. This influences the financing decision significantly. A manager in a common law country might prioritize an initial public offering to raise funds, while a manager in a civil law country might prioritize a long-term credit facility with a lead bank. These legal underpinnings dictate the level of financial risk a firm can comfortably take on and the degree of transparency required to operate successfully. Finally, we must consider the reality of the multinational corporation, which operates across these various systems simultaneously. Global corporate finance requires a synthesis of all these ideas. A financial manager at a global firm must decide where to incorporate, where to list shares, and which currency to use for financing, all while accounting for the different economic systems of the countries in which they operate. They must manage the risks of currency fluctuations in market economies, the risks of expropriation or policy shifts in command or transitional economies, and the diverse tax implications of mixed economies. The principle of capital structure becomes much more complex when the firm can borrow in one system to fund investments in another. For example, a global technology giant might use its high cash reserves from sales in market economies to fund the development of infrastructure in an emerging market, recognizing that the long-term growth potential in the latter outweighs the short-term institutional risks. In summary, corporate finance is a versatile and adaptive discipline that takes on different characteristics depending on the economic system in which it is practiced. From the shareholder-focused, market-driven models of the West to the state-led frameworks of centrally planned systems, and from the ethical partnerships of Islamic finance to the relationship-based structures of emerging markets, the goals and methods of the financial manager are constantly evolving. Understanding these differences is not merely an academic exercise. It is a practical necessity for anyone seeking to manage capital in a world where the rules of the game can change at every border. By recognizing the impact of laws, institutions, and state priorities, the financial manager can move beyond simple formulas and develop a truly strategic approach to value creation. This immersive understanding of global economic systems ensures that the firm remains resilient, ethical, and profitable, regardless of the environment in which it operates, ultimately fulfilling its role as a vital engine of economic progress across the globe. Through this progressive building of knowledge, we see that the heart of corporate finance is the ability to adapt universal principles of value to the specific, vibrant realities of our diverse global economy.